In this presentation, we will discuss budget timing. Typically, the standard budget for most companies will cover a year. So we'll have the annual budget, which will cover the next year. We're looking into the future, of course. We're doing the budgeting process. We're looking for the future year. Once we have that future year budget in place, we'll often break that down into smaller chunks, those smaller chunks typically being a quarterly budget, and then possibly even smaller into monthly budgets. If we take that yearly budget and then break it down into quarterly and monthly, that gives us some feedback that then we can go on as we go through the year. So as we go through each month, as we go through each quarter, we can review what we're doing as we go. We can compare actual to what we budgeted to happen. We can see the variance or the difference, and we can make decisions and adjustments as we go through that year. So we can also envision it in this way. We would have the annual budget. That's going to be the overarching budget that we would then make. And then within that, we're going to have the quarterly budgets that will then break that annual budget into. And then we'll have the monthly budget. Then as we go through the year, every month, we can take a look at that monthly budget, do the comparison on the monthly budget. Every quarter, we can take a look at that, compare the actual to the budgeted amount for the quarterly budgets. And of course, do the same thing for the annual budget as well. Some companies may also prepare a rolling or continuous budget, and the idea of the rolling or continuous budget is for us to update the budget after each time period. So as a period goes by, say a quarter goes by or a month goes by, then we're going to update the budget so that we're always looking out a year into the future. So as the quarter goes by in our example here, we then recalculate the budget and we look out a year out, so that we're always looking out that year into the future. We're going to update the budget as we go, as we roll through the process. We'll do the same thing for the next quarter, so it would look something like this. We have the standard yearly budget, and then a quarter goes by. We're going to reset the budget. We're going to look out a year based on that new information. As we do this, you can see that it has a few benefits of it, and some costs, of course. One of the costs is it's going to be more expensive for us to think about how are we going to reset the budget after each period that goes by. One of the benefits is going to be that we can have that comparison as we go through this. We can have that whole communication process again as we reset the budget, as we think about how it goes out a year out. And we can always be thinking a year out into the future. So when we consider the budget, we're always kind of viewing 1 year out into the future. And you can think of it as a car driving down the road. You can only see as far out as your headlights go. Well, the headlights are always going, a year out into the future. They always have that standard set, that standard look as we are budgeting through the process. So we can think of those headlights staying out there, giving us that focus as we drive down the road.